Welcome to Chapter 21 homework from Pearson. Let me go ahead and share that homework here. All right, only 8 exercises. I had some other exercises to hand out, but I don't see how I can test on that in the current environment. So this will be a shortened number of exercises for you to prepare for the exam. These will be typical of what you would see on the exam, not exactly alike, but I'll have a selection from Pearson to choose from. All right, so the first one here is this retail outlet. They incorrectly recorded inventory. So that tells you it's an error, correct? Which means what you do when it's an error. It's retrospective, retroactive. You go back, you got to change retained earnings if the books are closed. And it says rather than recording ending inventory as 840, they recorded as 480. So understating ending inventory by 360. So if it's understated by 360, then what do we need to do? We got to increase inventory by 360. And so we increase inventory by 360. And because the books are closed and we're not worried about tax here, ignoring income tax effects, then we just take it and put it into retained earnings. Because if you're putting it back on your books as an asset, coming off your income statement, right? As expense, as cost of goods sold. If the books were still open, what would this transaction be? It would still be a debit to inventory, but the credit would be cost of goods sold. The books are closed, that's why it's retained earnings. Okay. Number 2. What we got going on here? Concord Pharmacy started operations, used the average cost method to value its inventory for book and tax. They elected to change its inventory valuation method to FIFO, basis for financial reporting. Concord still uses the average cost method on the company's tax returns, subject to 35% tax rate. Let's click on this, see what that shows us. Start on January 1, 2011. And so January 1, 2015 is when they started. So I guess 21 or 2011, 12, 13, and 14, what is that, 4 years? We need to add up those 4 years, you know, kind of like what I did in that PowerPoint in the last video, and take the difference there. Let's see if they've done that for us here. Yes, they have. So I don't have to go to the scratch pad and do it. So you got 4 years. 2015 is not relevant because you're still, the books are open there. Here we're concerned about making the prior period adjustment. And so to make the prior period adjustment, and they don't add all these up together, they do as cumulative, that's fine. But you can just add up all 4 of these and compare it to these 4 and get the same answer. So the change in retained earnings is $109,200. How do we get that? Well, it's the $353,000 net of tax. Net income divided by 1 minus the tax rate, 35%. Says our inventory needs to be adjusted by $544,000. All right? Because they're talking about net income. You got to pay attention to that. Net income after tax table. All right. That other example we looked at online in the PowerPoint was the change in cost of goods sold. This is net income. All right. So my net income, cumulative effect of net income net of tax, $353,600. 75.8 plus 77.6, 153.4 plus 91, 353.6. So my change, cumulative change in net income divided by the tax rate tells me what my inventory adjustment should be. 544,000. There's my inventory. Retained earnings, because that was already after tax, wasn't it? After tax table. 353.6. Inventory. So the difference has to be my deferred tax liability because it's a credit. I'm going to pay the tax later. All right. I'm changing this for purposes of financial reporting versus income tax. It's got a temporary difference here. And then when I fill out my income statements, comparative income statements for last 3 years, 2015. Remember, 2015, books are still open. So you don't have to restate anything in 2015, but you do have to restate 2014 and 2013 based on this change. The gap change is my financial income change. And then if you want to fill in the blanks on this bottom part, which is important, you're going to do this retrospectively, right? Income tax is greater by how much for those 2 years? All right, so that's number 2. Number 3, this is a revenue question. I had several handouts for revenue recognition, but we won't be able to do those in this environment. Here we have Bremer adopted the percentage of completion method when it began operations. The company elected to change to the completed contract method on January 1, 2015. So we've got 2 years under the percentage of completion. And due to a change in size computer network contracts, net income under both methods for the first 2 years is presented in the following table. All right, but 2015 is still open. So we got 2 years, don't we? 164 to 142. So it looks like my net income doesn't say anything about tax. Of course, that's after tax. Anytime you see net income, that is after tax. 164 minus 142 is $24,000, and this is 21. So what do we have there? $45,000. $22,000. I'm sorry. 22,000 and 21 is 43. Yes. See that? $22,000 first year, $21,000 the second year. 2015 is still open. So we're going from percentage of completion to completed contract. So in essence, my income is going down, isn't it? I'm reducing my retained earnings. So I got to go back retrospectively and make those changes. That's why we are debiting retained earnings. What's this thing CIP, construction in progress? Well, you would have had that in Chapter 8 with revenue recognition. That's where it goes. CIP is used in a lot of ways. It's used for property, plant, and equipment when you are accumulating the costs associated with a capital project that you're doing, but it's also for a company who builds things for other, like a Burwell building the stadium out here. They have CIP as well, where they accumulate all those costs as an asset, and then they turn that asset over to like ETSU at the completion, and then take it out of CIP with a credit. So here they're reducing the amount that's in CIP because of this change from percentage of completion, which recognizes income as you go along, versus completed contract. That's a good teachable moment for Chapter 8. All right, percentage of completion, if you got a contract here, completed contract, a lot of times you do that for the IRS. And then percentage of completion, you got these various points, maybe it's 25%, 50%, 75%, and then you got 100%. Percentage of completion. Revenue recognition. So you got a timing difference there. The completed contract here for financial reporting, they're keeping percentage of completion for the IRS. That sounds kind of strange if I read that correctly. But that's what you're doing there. And how does CIP play out in all of this? Well, construction in progress, CIP, okay, contractor that might be using completed contract and percentage of completion, maybe Burwell or I don't know who the other one, J Street, I don't know what they use. But they're accumulating all those costs here as an asset. That's what CIP is, an asset. They're accumulating all those thousands of transactions until finally at the end, whatever the total amount is going to be cleared out to zero when the project or the completed project or completed product is handed over to an ETSU or whoever it might be. Or Food City, they're building the Food City building, but that's CIP. So the fact that they're now going to complete a contract, right, from that prior slide, they need to what? Credit that to reduce that because you're delaying to complete a contract till the end. All right, so that's a good tie into chapter 8. You can read that and work through that yourself on your own. With online exams, all of this is in play, so you need to make sure you understand what's going on here, not just the journal entries. You are doing this retrospectively. You're reducing 21,000 in year 1, 22 in year 2. And even the current year is 14,000 different, but you're not making a retrospective entry for the current year because the books are still open. The books are closed, revenues and expenses are zero. You got to go back and do that against prior period adjustment, retained earnings. All right, number 4. This is a rather long one, and it's really not that difficult. It's just there's a lot of cut and pasting, if you want to use that term, cut and paste or rekeying of data for this particular problem. Because I remember this one. Treadwell adopted average cost, and now they're going to FIFO. So you're already thinking here, this is change in principle. So the following information is given, a lot of information there. For ending inventory, cost of sales, cost of goods sold, right? Same thing, retained earnings. And they give you an income statement here as well, which is used for all of these. Sales revenue, selling, general and administrative, income tax. So this is just stuff you got to plug in down here as you go through this problem. So they start out, they want you to do the income statement under both methods. So the average cost is first. So sales, again, all that information is given here. 178, 165, 141. You're not putting in 2015 because the books are open for that one. All right, so we want to plug all that in. What's my cost of goods sold for each of those years under the average cost? You just have to go over here and find it. 76.1, 82.4, 95.2. There it is, 76.1, 82.4, 95.2. They go in the opposite direction. Here's the latest year going back. All right. Leave it there for a second so you can see it. Then we do the same thing for FIFO. Plug in the same numbers there for sales. Then cost of goods sold, you got to pull that off. What's given, all this information is given, you're just plugging it in there to come up with what your net income or loss is each of those years. Then requirement B is sort of taking what you did in these first two and doing what? You're going to do the FIFO because you're changing to FIFO basis. So now you're just pulling in what you just did up there in that prior example, although in a different order, the same information there, right, to show what your restated statements would look like. All right, and then they want you in Part C to restate your retained earnings. We had this back on another chapter. You know, you start out with your retained earnings as previously reported, 71.5. Where do we get that? Let's see here. Retained earnings, 12/31/14. 71.5. There it is. That's what was reported because we were under average cost method until January 1 of 2015. So 71.5 is what we want to start with. What's the cumulative effect of this change in accounting principle? Well, let's go right back up here and see. 65.10. You have to take the difference between, well, if you add up all three of these, 20,860, 32,340, 22,680, if you compare that average cost method, which you were on, and take the difference between that and 23,450, 35,210, and 23,730. The difference in those 3 years for those two cost accounting or cost methods for our inventory, it's $6,510. So we're going to add it, that's income. So we're going to have more income after tax under FIFO than we did under average cost. So that's my adjusted December 31, 2014 as adjusted 78010. Then the net income here is for the current year. So we just go up there and actually use current year information for the FIFO method. And that gives me my retained earnings for the end of December 31, 2015. All right, let me go up here and click on the solution, see if that adds any insights than just me talking about it. All right, you do have to calculate the income tax expense on each of those. It gives you the rate for average cost and also for FIFO for the 3 years that you're making a prior period adjustment for. Then requirement B, because that's what you're adopting, right? Requirement B, FIFO for 2015. And then requirement C, there's the difference between each of those years laid out for you that you've already done. So you got more income in each of those years going with FIFO versus average cost, 6510. And that's after tax. All right. That was really hard to write on the, I know if you got a big board, you can do it, but not impossible to do on a scratch pad or a notepad. All right, number 5. This is a change in estimate. And this is interesting exercise here, the way they work this. And I won't have to write this stuff down, so when I go to the notepad or SmartPad, I won't have to go back and forth. So they've got a book value of $26.13 at the beginning of the current year. There's a $519,000 salvage or residual value. And its useful life is 25 years. It says at the beginning of the current year following 10 full years of depreciation. After 10 years of depreciation, the company determined the asset will only be useful for another 10 years. And the salvage value then is going to be $170,000. The change in estimate is needed to reflect extended usage and running the factory above normal capacity to meet increased demand. They use a straight line method of depreciation, company subject to 40% tax rate. All right, so what's the original cost? This is like a puzzle. What's the original cost? Because it tells you the value is 2613 after what? 10 years. So we're trying to go from 2613 back to year or the original cost. How do we do that? All right, well, let's go ahead and scratch pad and see if we can figure it out. Let me go ahead and write down the answers here. 4,009,000 and then 139,600. And then going forward, our depreciation is going to be 244,300. All right, so let's go over here to SmartPad. See if we can work through this. So we're at 2613 after 10 years. And the salvage value is 519. So my book value right now that's being depreciated is 0,004. That 209.4. Let me calculate it here so I don't. $209,400. So that's my current book value or carrying value. And it says that I've been depreciating this based on 25 years, 10 years. So there's 25 years. So if 10 are down, I got 15 more. So if I divide that current amount by 15, that should tell me my depreciation per year, which is 139,600. I remember that as being correct. So that's my depreciation expense. Last 10 years. Or these first 10 years, right? All right, 139,600. So if I've been doing that for 10 years, what's 139,600 times 10? 139,600. That's my accumulated depreciation. All right, and so if I've got 2613 current book value, then that says my original value must be 4,009. That's my original cost. And that's what I wrote down. Yep. A little bit of a puzzle. It's good. Kind of tying in last semester with this semester. All right, so this is where I'm at. It tells you the book value is 2613. What's the new salvage value? Was there a new salvage value? Is it 170? I wrote 170. I don't know what that number is. Maybe that's what it is. So 2613,000 minus 170, 2443,000 divided by 10 more years. All right, because they said it changed. Start out at 25, you depreciate it for 10, but it's not 15 years left. They've changed it to 10 years, haven't they? Yes. So that's 244,300. That's going to be my depreciation expense in the current year, because this is a prospective change. A prospective change from what we have been doing on depreciation. Good faith estimate, been doing everything the way we thought, but it's a change in estimate, so we're going to change the depreciation the current year and future years. So the remaining 10 years is going to be 244,300. Let's go back and look at the solution. Again, there's the 4,009,000 original cost. There's the depreciation for the first 10 years. And then there's my journal entry. Depreciation expense, $244,300. Accumulated depreciation for the remaining 10 years. All right, then what do we fill this in down at the bottom? Remaining life of the company's planned asset has been reduced from 15 to 10 with a decrease in residual value. Annual depreciation is going up, isn't it, by this change in estimate? And they're wanting to, if they're going to be using this piece of equipment longer, they want to match this depreciation expense, right? Match that expense with the revenue it's going to produce. That's why they're doing this. Income from continuing operations after tax and net income decreased by $62,820. That's just the, what, 40%? Changes in essence reported prospectively decreased by $62,820. Let's go up here and look at the solution. There's the top part. There's requirement A, requirement B, then requirement C, and then D. Oh, they're taking the difference there on requirement D. Revised depreciation minus the annual depreciation expense on 1 minus the tax rate. That's how they get to $62,820. All right, so that's number 5. Number 6. Errors. I think all these errors are listed as we go, so I'll just click done on that. First one, prepare the journal entry to record or correct the error in recording the deferred advertising expense. I don't know what deferred advertising expense is, but that apparently was an asset. So we're going to credit deferred advertising expense, the asset, and debit advertising expense. There it is, $46,000 paid for advertising recorded as an asset in an account entitled deferred advertising expense. All right, number 2 or B, payroll for 2 weeks ended amounted to $129,500. Was never recorded. Payroll taxes withheld for this payroll period were $8,700. I think they're talking about withheld from the paycheck. All right, so what does that look like? We want to record our wages expense, $129,500, the $8,700 payable, and then salary and wages payable is the take-home pay. All right, what about the next one? Insurance expense. What's going on there? 2-year insurance policy of $126,000 on April 1 was recorded by debiting insurance expense. $126,000 on April 1. And it's 2 years, 24 months. So what entry do we need to make? $126,000 divided by 24, it's 2 years, is how much per month? That should be taken out of prepaid and put into insurance expense if it had been done correctly. But they've recorded the entire $126,000 as insurance expense, haven't they? So 126 divided by 24, it's $52.50. So what journal entry do we need to make? Said it was April 1. And see, all of this, the entire 126, is setting up there as insurance expense. All right, so if it's April 1, then we have 9 months of actual expense. So 9 times $52.50 is $47,250, if I read that right. All right, so how much needs to be in prepaid? 9 from 24 is 15, right? That times 15 is equal to the prepaid amount. 5250 times 15, 78,750. So prepaid insurance needs to have 78,750, and that 78,750 needs to come out of where? Insurance expense. That's a T account there, if you're wondering what that is. We're out of space. There it is, prepaid insurance, end of the year. 15 months left. Guess I kind of worked that the hard way. And then the last one, sales tax was not recorded separately during the year. The company's required to collect 3% sales tax on its sales. Company's credit sales amounted to $2,540,000 for the current year. So $2,540,000 times 3% is $76,200. So they're taking it out of sales revenue and putting it to sales tax payable. It's not really revenue for them. They're collecting sales tax and going to remit that to the state on a monthly basis. All right, number 7. It's like an inventory problem. Incorrectly recorded inventory in 2015, rather than recording ending inventory as 430. County manager entered 16, overstating inventory by 180, and inventory summary for 2015 and 2016. Which there it is with the error. 610,350. So what's the requirements? Prepare an analysis of this inventory of the 2-year period, recommending correcting entries. And comment on the effect of the error on gross profit. What correcting entries are necessary? All right, so what does it say about the books being closed? The analysis, first of all, that's given. So if you do this correctly, 300, 660, there's what it should have been, 430. And so 530 and 130 over those 2 years is 660. Ending inventory, beginning inventory for the next period. So 660, so that's the same as what you see here, right? 660 over 2 years is the same. But this is the correct version. Again, remember, inventory self-corrects. Now prepare the correcting entry to correct the inventory error. Where does it actually say, though, that when did you find the error? I guess you didn't find it till the end. There it is. Guzman discovered the error in 2016 before closing the books. I guess that's closing the books for 2016. All right, so 2015, the assumption here is the books are closed. So that's why we're making an inventory adjustment, aren't we? By $180. Take it out of inventory, put it to retained earnings, ignoring tax. Not real clear what they meant there, but all right, so what's the effect? The error overstates gross profit by 180 in 2015 and understates gross profit by 180 in 2016. It self-corrects. What journal entries are necessary? Guzman discovered the error in 2017 after the books were closed for 2016. Well, they're saying you don't make any entry because your inventory is accurate at that point. Of course, your balance sheets are incorrect and your income statement, but you're going to do that offline as opposed to making a journal entry. But a little bit strange there, the way they state that. Because it self-corrects is what they're saying. Your permanent accounts are accurate, including your retained earnings is accurate. Now, you probably have to restate those balance sheet and income statements, but you're not going to do that through your financial system, more than likely. All right, and the final exercise here. Let's see what's going on here. A lot of stuff. Says prepare the entry required to correct these entries in 2015 when they are discovered. Assuming the books are closed for both 2013 and 2014. All right, so what's happened here? We got a maintenance expense on account was overstated by $20,800 and understated by $30,700 in 2014. The payables for both years are still unpaid. So maintenance expense overstated $20,800 and $30,700. What's the net effect of that? $9,900, $20,800 minus $30,700. An overstatement and an understatement, those two have to be netted together. You'll see why here in a minute. $9,900. All right, what's the second transaction? Depreciation expense was overstated by $56,500 in 2013 and understated by $70,100 in 2014. All right, so how do we adjust that? Accumulated depreciation, $13,600. Right? All right, because we're adjusting the permanent balance sheet accounts. Everything over here on the retained earnings is, it would have been maintenance expense, it would have been depreciation expense. But see, those are gone. We got to go against retained earnings. And look at the last one. The last one's the tricky one. Sort of. Ending inventory was understated by $120,500 in 2013 and overstated by $178,700 in 2014. Now you don't combine those two. What's relevant is the final one was overstated $178,700. So the entire $178,700 has to be booked on here to correct your inventory. Right? All right. And so what's the net effect of all that? Because the net effect of that inventory adjustment is going against what? Cost of goods sold. Remember, if the books were still open when you caught this, retained earnings would be, there would be three titles there, not one. There would be three. There would be maintenance expense, there would be depreciation expense, and there would be cost of goods sold. Because the books are closed, you have to put it all against retained earnings. All right, so that is chapter 21. And we will pick up next time with chapter 22, the final chapter, which is statement of cash flows. And we'll see you then.